Hello and welcome to Hedgeye NextGen, where we're going to continue to help you build wealth and break finance down into its simplest form. We have Ish back.
Great to be here once again.
Yep. Some people were a little worried that we may have fired you, but you're back.
Yeah, I was a little worried myself, but I'm
Oh,
back.
they told you? And you passed the CFA level 1
Yes,
there.
thank you, thank you.
There you go. Congratulations. So now we're both CFA level 1s.
That's all we can say, I guess, right?
I'm pretty sure that legal. Actually, I'm not even. So I'm not taking it for. I'm not even sure if I'm allowed to say I was a level 1.
I think all you can say is I passed CFA level 1. That's it. So that's what we'll say.
You're legally compliant, and we're actually now putting out shorts. All right, so go check out our YouTube shorts. There are YouTube shorts on our next gen. But if you're here, maybe you saw them. But either way, we're actually looking pretty good there. Right?
Yeah, they're definitely more digestible format for the attention economy these days. So
Oh, the graphics are really cool.
the shorts are doing good.
Anyway, we're going to get into today. We're going to talk about tax shields, which may be like, what's a tax shield? Or you may be like, that sounds boring. Don't worry, it's not boring the way we're going to break it down.
You know, nobody wants to pay tax, so
I think I hate two people. One's the bank, one is paying the taxes. So I guess I hate the government.
IRS.
The IRS, they're after me. They're not after me. We're good. I pay the taxes. But if you don't have to pay banks, right, why pay the banks? But also, why pay the government?
Yeah, you got to pay them, but there's ways to pay them less legally.
Legally.
They will let you do it, and that's what we're gonna.
Yeah, that's basically what we're gonna cover. So we will get into like 401ks, Roth 401ks, IRAs. We'll get into some student or college type of savings accounts, which is like an ESA, even a UTMA. A lot of acronyms I was looking up today. But we will get into it. I think the first things first, though, right? Okay, so yes, we're going to talk about tax shields, right? But don't get lost in your tax shields, right? And also make sure to first pay off your credit card, pay off your car loans, pay off your student loans, pay off all your loans, guys, okay? And then this is the part afterwards where you are starting to invest your money, right? And then now you're investing, well, let's also pay some less taxes, okay? So first do all of that, and then you start worrying about a lot of this stuff, okay? So you always hear, right? Save 15 to 20% of your income for retirement. You've probably heard that a million times. Nothing wrong with that. Don't worry. Okay, but so how do you do that? Where can you invest, right? That's what we're going to try to break down here. So first things you should probably invest in are the things where you save taxes, because not only are you investing, but you're also not paying the government. It could be up to $8,000.
Right. So then you get to invest more.
And then you get to invest more because you're not paying the government $8,000. And we all know what the government's going to do based on a Social Security episode, where your return on any Social Security payment you're paying right now is less than 0%. Well, it's less than 1%. So, okay, they're not going to be investing your money. Let's just put it that way.
Yeah.
So you might as well invest your money, right? Pay them less, invest the money. You'll have more later. That's the whole goal today. All right. So, yeah, let's get into it. We're going to start with the 401k.
All right. The classic.
401k is a classic. Okay. Oh, by the way, if you're self-employed, there's special things for self-employed people, but most of you guys are not self-employed. So we're going to talk about those things. Okay.
Are we covering the self-employed vehicles or no?
No, not really.
Okay.
No, they have some crazy savings. They have like 401k equivalents, but
for the general population.
General population, we're just going to stick to the general stuff. If you're self-employed, their vehicles, maybe another episode. All right, 401k. Very simple, right? So your company probably, if not, has to offer a 401k.
Yeah.
Okay?
I think if you're full-time.
If you're a full-time employee, you have the option to do a 401k. Now, there's a couple of things with the 401k. All it really is you are putting in your money, okay, with pre-tax dollars. Okay, so what that basically means that you are lowering your like you're not getting taxed on it, right? Because if you get money today, right, you get a paycheck. Once you get the paycheck, they're taking out taxes.
Right.
That's your Social Security, federal tax, state tax, right? So what this is essentially before they take out taxes, you have money going into an investment account. Okay?
And then you pay tax on the remainder, which is less.
Right. You pay your tax on the remainder of your paycheck. So, right, maybe your paycheck is, say it's $3,000 every time. Okay. 600 goes to your investment account, never gets taxed, and the remainder 2,400 gets taxed.
And you keep maybe 1,800.
And you maybe keep 1,800 after tax, but that 600, it's in your investment account. You're not getting taxed on that.
Right.
When you get taxed is when you take out that $600 from the investment account. Okay?
That's in retirement.
It's at basically after the age of 59 and a half.
Okay.
Okay. That's the basics here, right? Pre-tax money for a 401k. Okay. So here are some things around the 401k. One is your employer might have something called an employer match.
Right.
That's
I mean, that's the best thing to have, right?
Yeah.
Free money, basically.
It's essentially free money. So what that is basically your employer is saying, if you put in 600, I will also put into that account another $600. I will match it.
Right.
Which is crazy.
It's not always 1-to-1, is it? Some of it is, because that's
so basically they'll say I will match up to, let's say 8%, which is 8% of your total salary. I will match that. So if you put in 8%, I will match the full 8%.
Oh, wow. Okay.
8% is really high. Most of them are between like 1 to 5%.
Yeah.
Okay. But either way, if your employer is saying I will match you, but even between 1 to 5%, you put in 1 to 5% because every dollar you put in, they're matching it.
It's basically a bonus, like 1 to 5% of your total salary.
Exactly.
Exclusively for your retirement.
Exactly.
Okay.
It's great.
Yeah.
Fantastic. Now there is something which I got hit with on one of my first jobs is they actually call it a vesting schedule. Okay. If you've never heard of vesting, basically it's the company saying when you get hired, like, hey, we have a great match. It's 5% of your total salary. Great. But what they don't tell you is you unlock that 5%, that money we're putting in over the next 5 years as long as you're employed with us.
So you have to unlock the match?
You have to unlock the match over a 5-year, or usually it's like a 20-year period. So it's a quote unquote match, but only if you stay with us for X amount of years. And if you don't, we take your entire match.
Oh, so it's like a conditional match. Like they're not really giving you the money.
Yes. So I got screwed on that in my first job. And so make sure to watch out for that. Yeah.
So not all matches are equal.
Not all matches are equal. Make sure to ask if it's if you have a vesting schedule or so forth. Oh, I was so pissed-ish.
Did you not end up getting the match at all?
No, I did not.
Okay.
Well, I was never going to stay with,
right, so you weren't there for the time, I guess.
No, I was there for maybe 1 to 2 years, essentially. I could have stayed longer. It was a company. I shouldn't. Okay. Either way, it was a company, right? And basically it was like they had a great match. So I was like, oh, this company, okay, I'm just getting great employee benefits. And I was like, okay, I think I need to I've outgrown this. Maybe I need to move somewhere else. And then I lost half the 401k. I was like, what the hell just happened?
You didn't lose any of the money you put in.
No,
it was just what they were promising.
Exactly. I lost their half.
I see.
Right. So in my account, it was a big number. I moved and it was half the size. Wow. I was like, wow, this is a little crazy.
Got it. See what their terms are, I guess.
Yeah. Well, then I went to the employee handbook and I did some digging and it was essentially they hide it. It was if you have questions on this, make sure to ask the HR professional. So if you never ask the HR professional, they'll never tell you that it existed.
Wow.
Yeah.
Okay.
Yep. So from that story, make sure to ask about this match. Okay. Next big thing with 401ks is you can't withdraw them until you're 59 and a half years old.
Okay.
Okay. And there's a 10% penalty if you withdraw before that.
Right.
So you are locking in your money until you're a certain age.
Yeah.
Okay, so it's not like you can't like buy a house with this money. This money is locked up behind a closed door.
All the way until when you're retired.
Basically until you're retired, then you can start withdrawing the money. So it is locked up.
Unless you pay 10%, which is kind of a lot.
It's a good amount. You don't want to pay 10%.
No.
Okay? And you are contributing pre-tax dollars. So that is lowering your taxable income, which is fantastic. And then let's do an example on lowering your pre-tax income. So this is the biggest part of this.
Yeah,
okay?
it's definitely the biggest benefit besides the match. Not all of them have a match though, right?
Right. Not all of them have a match. In fact, more and more companies are not doing a match.
Wow.
Okay, let's get into an example here. All right. So what we're going to do is we'll go through everybody's tax brackets, okay? And then we'll go into, based on how much money you put into the 401k for a given year, how much you're going to save in terms of taxes. So I have every tax bracket and every dollar amount. Okay. I should also say the max you can contribute to a 401k is, what was it?
It's like 23.
No, it's $30,500.
Okay.
That's the max. So you can contribute more, but it's not pre-tax income anymore. You have to pay taxes. So,
oh, interesting.
So you basically, the idea is you contribute up to the 30,500, and then that's all pre-tax dollars.
Yeah.
And then anything above that, you can just put it anywhere. You could put it into
put it in like somewhere else.
You could put it in a brokerage or whatever, but you're not getting the tax benefit from it. Okay. So we're going to use Connecticut since we live in the great state of the Connecticut.
Yep.
And so let's say here are your tax brackets for a single person. If you're married, you just double it. Okay. So if you we'll start with $47,000. You're going to get hit with a 16.5% tax on your income. Okay.
That's just the regular income tax. Right?
Yep. 12% is federal and 4.5% is state tax.
Okay.
Right now, if you live in a place like New York City, it's probably higher.
Oh, yeah.
If you live in New York, it's probably higher. California is probably higher. But either way, Connecticut is what we're going to use. If you make about $100,000, you're going to get taxed at 27.5%. That means 27% of what you make goes to the government.
Yeah, you just don't keep it.
The big man upstairs. If you make about $192,000, 30% of your income is taxed.
Okay.
If you make $244,000, 38% of your income goes to the big man upstairs.
Okay.
If you make about $609,000, 42% of your income goes to the government.
42% of your time was spent working for the government.
Pretty much.
Topic for another time.
If you make anything over $610,000, anything above that, 44% of your money is going to taxes.
Okay.
All right. So now let's just say, so let's say you're making under $47,000 a year. That means you're being taxed at a 16.5% rate.
Right.
Okay. So if you put $10,000 into your 401k, you're going to save $1,600, $1,650 essentially, because what happens is that money that goes into the 401k, that $10,000 is not being taxed. So that $1,650 would have gone to the government. Instead, it's going into your investment account. Okay?
Yeah. Makes it so that you don't pay tax on whatever you're contributing, basically.
Exactly. Now, if you do the max, if you were able to contribute $30,500, which is 90% of this person's salary, so this is very unlikely.
It'd be a lot unless they have zero expenses.
Yeah. That person would save $5,000 a year. Okay?
Save and invest.
Save and invest $5,000.
Okay.
Basically, it's money not going to the U.S. government. All right. Let's say you make $100,000, just under anywhere between $47,000 and $100,000. So the average income is about $60,000 to $90,000. This is most people. Okay. So for that person, your tax is about a 27.5% tax. Okay. If you put $10,000 in every year, $10,000, you are saving and investing $2,750.
Okay.
It it's not an
No,
insignificant
that's a
amount of
good
money,
chunk of money that goes towards your investments
and not the
and not
government.
just like disappears.
Exactly.
So,
It's pretty big.
yeah.
Let's say you're able to squeeze out $20,000, maybe. Then you would save $5,500. You get basically
Pretty good.
it's pretty good. It is pretty good. And if you're able to save the 30,500, the max you can do is $8,300.
Okay.
So
Yeah.
pretty good. And we'll do one more tax bracket. Anybody that's making between $100,000 and $191,000, you're going to be taxed at 30%. Okay, if you're being taxed at 30% and you're able to put $10,000 into your 401k, you save $3,000.
Nice. And if you do the maximum,
If you do the maximum, $9,150.
almost 10 grand
List
saved.
10 grand going into your bank account.
That's great.
And then we'll do the max of the max, because why not?
Sure.
Let's say you make more than $610,000. Well done out there, laddie. And you get taxed at about 44%. And if you do the max for them, which is $30,500 into your 401k, every year they're saving $13,420.
Wow. Every year.
Yeah,
That's
it's yearly, because
Yeah.
every year that's how much you should put in. Okay. So that is why the 401k is big. You want to get as close to that max contribution as you can.
Yeah.
But obviously you want to you want to pay off your expenses. You want to live off what you can afford. Like, you want to save 15 to 20% of your income, right? Just think about that, but also know that, like, you can't buy a house off this money. You can't.
Right. It's nothing. You're not saving a ton of money, but it is a meaningful amount.
It is a meaningful amount, and the more that you're able to save and not pay the government, the better.
It's more compounding.
Right. It's just more compounding for your retirement. So that's a traditional 401k. Okay. Now there's something called a Roth 401k. Now, some companies offer this and some do not. Okay. So if you're one of the people where the company does offer it, it's actually a very good vehicle. And here's the only difference. Okay. Only difference is you pay your tax up front, but then when you want to withdraw the money, you pay zero taxes.
Okay.
Okay.
So it's post-tax income that goes into it.
But on anything that you make, you pay zero. Right? In a traditional yes, exactly. A traditional 401k, pre-tax money goes in, but at 59 or 60, you have to pay taxes on that money as you withdraw it.
Yeah.
Okay? But in a Roth 401k, you pay taxes up front, and then as it compounds, when you withdraw at age 60, there's zero tax.
Right. So for the traditional 401k, when you withdraw, it's not like capital gains tax you pay, right? It's an income tax on the withdrawals.
Yes.
I think.
Yes.
So the big bet with just going back to the traditional.
Yes, it's an income tax.
You pay income tax. You don't pay income tax on the money goes in. You pay income tax on the money coming out. So the real savings it's really a bet on yourself being in a lower tax bracket by the time you're retiring. Is that right?
So yeah, one, it is an income tax. And so yes, the bet is on the Roth 401k is that as you get older, you're going to get into a higher tax bracket than you are right now.
Okay.
And because you're going to be in a higher tax bracket, so maybe right now you pay 16% of your money in terms of taxes, and then when you retire, maybe you're at 40% of your money is taxed, right? So with the Roth, you pay your tax up front, which means you pay at a 16% rate, not in the future where it might be a 40% rate.
Okay.
That's the whole bet with the Roth IRA. And so that's why most people say
The Roth 401k.
yeah, the Roth 401k. That's why most people say go with the Roth 401k or the traditional 401k if the company offers.
Yeah.
Now let's talk about the expense ratio, okay?
Okay.
So for 401ks, you do not get to really choose individual stocks. It's kind of, there are a set amount of plans that the company offers.
Probably mutual funds.
Mutual funds, ETF, mostly mutual funds, okay? And the biggest thing is there's something called their target date funds, okay? We here at Hedgeye, we do not like target date funds, but let me explain why. Okay, they have essentially what the target date fund is. It says, okay, what is your age? Okay, and then based on your age, it will move your money into more or less risky things. Okay. Now, for them to do that, they charge you more money every year. Okay. And what you would and maybe the bigger problem is, one, they're charging you more, right? So you might be charged 1.5% a year. Okay. And the returns aren't that good. They're mediocre at best. So they're charging you more for less returns.
Yeah.
Okay. So the biggest thing you have to look out for on these plans when you go through your website, it's called the expense ratio. That's how much you get hit in terms of how much or they take out of your account every year.
So you gotta be careful, like where within the retirement vehicle you put your money.
Exactly. Which fund you choose, because basically the companies are very smart that offer these plans. They make these plans. They know you have no idea what an expense ratio is, and they'll just make it like 2% or something, right? Where really there's probably an option for a 0.3% expense ratio. So you're just paying double to triple money of the money to these people for less returns. Okay, so basically you just watch out for that, and you can look at the returns online. Like, you literally type in the fund name and you just see the returns and look at those expense ratios.
See if it's worth what they're charging.
Exactly. And I would stay clear of those target date funds. They say, hey, you don't have to do anything. Like, they're just moving your money about 5 times in your life. Okay. Like, you really need to pay 3 to 4x for them to move your money that many times? No.
So I think the Roth 401k sounds better than the traditional 401k. You don't pay any taxes on anything that comes out. I mean, if we're expecting it to appreciate, then like, why wouldn't you go with that one, right? Is there any reason?
Yeah, there's really no reason. The only reason is if you think you're going to make less money in the future.
Okay.
Or if you think taxes are going to be less, and they're going to cut the tax rate.
So then because you'd rather pay that tax rate than today's
tax
rate. Okay.
So you either think that they're going to cut the tax rate in the future, or that you're going to make less money tomorrow than you do today.
Yeah.
It's the only reason. And then the big one is there are no income limits on the Roth 401k, which is going to be different from the IRA, which we'll get into. But
right.
So if your company offers it, you can get into it.
Okay.
And I would recommend for most people that Roth 401k it's a great vehicle.
Yeah.
All right. Now, IRAs. Okay, so that's the 401k.
IRA, individual retirement
account. So this is not something your company will offer. This is something you have to go outside the company to find. Okay. You have to set up yourself. Okay, but we're going to help you here. All right. So here's what an IRA is. It's very similar to a 401k. You can't withdraw your money until you're 59 and a half, unless there's a 6 or 10% penalty, just like the 401k.
Okay.
So you're putting your money in and you're locking it up. It is pre-tax dollars. Again,
the traditional IRA.
The traditional IRA is pre-tax.
Okay. It's same thing as 401k.
Same exact thing as the 401k. Okay.
Is there any difference overall?
Now the difference is there's a contribution limit of $7,000.
Okay.
Okay. So the max you can put in is $7,000 pre-tax. Okay. Okay. Got that?
Yeah.
And the max you can contribute on the 401k was $23,500.
Okay.
Right. And then you add the 2, that's $30,500.
Oh, both combined.
Both combined.
Okay.
Was the 30. That was my mistake, everybody. But we'll keep moving here.
That makes sense.
Okay, so this one's $7,000 contribution. 401k is $23,500.
Okay.
Okay, and then you can open it at most brokerage accounts, like literally any brokerage account. You can open one of these, and the investing options are a lot. You can actually get into single stocks.
So that's, I assume, the big difference is that it's a wider array of investment opportunities.
Wider array of investment opportunities and a lower contribution. So you can only put in 7,000 pre-tax versus the 23,500.
Interesting.
But combined, that's 30,500.
So you can max out on both combined.
Exactly.
Okay.
Exactly.
That would be the way to like save the most for your retirement.
Exactly.
If you can save that much.
Exactly. And so that's the IRA. Very simple, just like the 401k. Only you can do single stocks and
so more variety,
yeah,
lower limit.
Yes, exactly. Now, there is a Roth IRA as well that you can do. Okay. Now, it's the same as the Roth 401k. You pay your taxes up front, and then when you go to retire, you don't have to pay any taxes on it.
Right.
Okay. It's the same contribution, so it's at $7,000 is the max you can do. Now, here's the only thing with this one is there's an income limit.
Right.
So this one you have to make less than $165,000 if you're separate, or less than $246,000 if you filed jointly.
Yeah, they made this one a little tighter because it's pretty overpowered. The Roth IRA.
It's really good.
You could invest in a lot of different things, anything, crypto if you want, in a Roth IRA. Yep. Don't pay taxes on any of the gains.
Mm-hmm.
That's the best deal. So of course they hit you with a 7,000 limit plus an income limit.
Exactly. So that's the Roth IRA.
So take advantage of that one.
Yes.
Yeah.
Yes. Exactly. Now there is something called a backdoor Roth IRA.
Backdoor.
So this is where I would talk to a financial advisor if you're going to go the backdoor route,
okay.
but I'll give you the basics of how to do it, but make sure to talk to your financial advisor. So for this, because there's a lot of paperwork for this, so to get it right, what you do is, this is for people who make over $165,000, okay?
Okay.
And they came up with this tax loophole, okay? What you do is you put all your money into a traditional IRA, and you convert it to a Roth IRA.
Okay.
Okay. So what they do is your traditional IRA has to have no balance. You have to wait for your holding period, and then you convert it to a Roth. Then you pay taxes on it, and then you file out an IRS form 8606, and then you complete your tax return, and then it's essentially you create this Roth IRA.
So it's a way to get the Roth IRA, and if you are being like barred from it by the income limit, yes, right? That's what the backdoor is for.
Yes.
Okay.
And talk to your financial advisor so that they do it right, and because
that's interesting. I didn't know about that.
Yeah. So you'll hear a lot of people say, there's a backdoor Roth IRA. That's what it is. I've never tried it, to be honest with you, but good to know it exists.
Yeah. Okay. So I guess it's like if you're over that income limit and you really want the Roth IRA benefit of not having to pay the tax on your gains, you just put it into all of that 7,000 into a traditional IRA and just convert it.
Convert it. Exactly.
Okay.
And then you pay taxes on it that year, and then you won't have to pay taxes on it going forward.
Okay. This is probably a pretty niche.
Very niche. Very niche one.
Don't have it
out there. Very niche.
I didn't know about that.
So yeah, again, remember the 401k, the max contribution is $23,500. So that could be all pre-tax dollars, and then $7,000 on the IRA, which is the $30,500 that you can save on those taxes.
So here's a question. I assume it's $23,000 for both Roth 401k and regular 401k.
Yes.
But you can't do 23 into both.
No, you can't.
And then for the Roth IRA versus traditional IRA, can you do 7 into both? Or
no?
So you got to pick one.
Pick one.
But you could do Roth IRA, traditional 401k.
Yep.
Or Roth 401k and traditional IRA.
Yep.
Or Roth both.
Exactly.
Okay.
Exactly.
But your maximum to any of these vehicles combined is the 30,500.
Yep.
Okay.
Exactly. And remember, your money's locked up. right? So it's lockup 260. So if you're trying to buy a nice engagement ring, you can't buy it with your 401k.
Yeah.
Do not touch this money. Do not pay the 10% penalty.
It's not worth it.
It's not worth it. Also, if you're reeling credit card debt, maybe pay off the credit card debt before you start contributing to this. So get yourself financially sound first.
Yeah, absolutely.
Right? Do that. Maybe if you have the private student loans that are like 9-10% right now, right?
Yeah.
So like think about that as well when you decide how much to put into these, and then obviously then you can grow it every year. I'm pretty sure you can change how much you contribute like at any point in time. Like it's very easy to do.
So you should probably be at the bottom of your financial planning stuff.
Exactly.
First pay everything else that you owe, and then what's left put into retirement. Try to maximize that. But if you do it first, then your money's tied up and you might have problems.
Right. So you're saving on the taxes, but you have 20% tax. I mean, a 20% credit card interest, right? You're just losing on all the taxes anyway.
You're not saving anything.
You're not saving anything, right? Yeah. Okay. So that's that. So now there's one more savings that's pretty good. Now this is after I've maxed out my contributions, right? Exactly. Max out both. Okay. I paid off all my debt, the bad debt, right? Which is the student loan, car, and credit card, right? You're like, okay, what else can I do to save on taxes?
There's more.
Okay. So this is an interesting part. It's child education. Okay. So also we're just getting a little bit more niche out here, right? It's just the levels here, Ish.
Got to inform the people.
Well, I mean, if you go in state, the tuition is about $29,000. Okay, out of state is about $47,000.
Just on average.
Yeah. Okay. And a private college, this is all colleges, is about $60,000. Okay. It's expensive, all right?
Oh, it's expensive.
So, but there's ways. No, I'm not having a kid. So one is called an ESA.
Okay.
A lot like a Roth IRA, which is great. What you can do is you can put $2,000 a year in after tax per child. Okay. And then you can take out that money tax free. Just like a Roth. It's essentially it's a Roth IRA for a kid. It's tied to a kid. And then you can put $2,000 in a year.
So this isn't for retirement.
Nope.
I assume it's for paying the kids' tuition, so it probably has a different time frame on it versus like the 59.5 rule.
Exactly.
But it is the same tax shield. It's a way to tax shield your money and investments.
Exactly, because think about it. Like if let's say you're lucky enough to have a savings account for your kids to put them off to school, instead of getting instead of having to pay more taxes, right? Because you might have to put that money in a brokerage. Yeah. You have vehicles to help you shield some of that to help
save more. That's pretty good.
Exactly. So it's a Roth IRA where it's $2,000 per kid.
Do you need to have a kid to open that up?
I don't know, look that up.
Because if not, then you could just put 2,000. No, you probably do because you said 2,000 per kid, and I'm sure they're measuring that somehow.
No, you don't have to have a child to qualify for ESA, but that's a pet.
Maybe you need to. Maybe if you have a nephew, you don't have a child, but you're still doing it. I assume there's got to be some connection with a child that will be going to college, or else you could just put 2,000 in. If you have no kids, you could put 6,000 in. Say you have 3 kids or something, pretend, and then take advantage of the tax shield.
Yeah, no, anybody can open one, including yourself. But I think there has to be a beneficiary.
Right.
Okay. Yeah, I don't know a lot about that, Ish.
I think that was it. You got to assign a beneficiary.
Yeah.
You can't just game the system.
Right. Right. So I don't know how the kid would be a beneficiary if it's not even alive.
Well, it doesn't have to be your kid.
It could be any kid, you think?
I think so. I'm just guessing.
Okay.
If I could make one for your kids, not that you have any yet. That's how it would work.
Okay.
But I can't just do it for myself.
Talk to your financial advisor on this one. All right. It's beyond my pay grade.
We're just telling you about it.
All right. So how this is most commonly used, okay, is for your kid.
As it should be.
Okay. Think about it, so basically It can go towards tuition. It actually can go towards pre-K, like kindergarten to anything like intermediary school.
So not just college.
Yeah, it can go to So if you're sending them off to a boarding school or something like that, it can count, or a private school. It can also count there. It can count towards books. It can count towards like a good amount.
As long as you like, I'm guessing you just gotta like justify and make the case that it's for the
Education.
Okay.
Yes. Okay. And so just think about it, it's from 0 to 18, and 18 they often go to college. Okay. So, but if your kid doesn't, so we'll get into that. But what that is, so let's say you put $2,000 in from the ages of 0 to 18. You put into this account $36,000. Okay. And if you invest it and you get 10%, your return, you'll have $112,000 when it's time for the kid to go to college.
Factoring in compounding.
Factoring in compounding.
Wow.
Okay. So you put in 36,000, you get 112,000 out. I mean,
and you're saving on taxes.
And you're saving on the taxes coming out. Okay.
Not bad.
Not bad. Here's the problem. There's an income limit. Yeah. Oh, but you can invest in, I think, stocks on this one too.
Okay.
So it's very nice in that. But there is an income limit. It's $110,000 or $220,000 if you're filing joint.
Okay.
Yep. Yeah, it kind of sucks.
Yeah.
But you can have this money until you're 30. And if a kid doesn't use it, you can roll it over to the next kid. So you can roll it over to another kid. And if there are no other kids, then it can be distributed. That money can be distributed to you, but it gets taxed and there's a penalty.
And you lose the benefits.
Yeah. And if that happens, I think just talk to your financial advisor. There might be a loophole there. I don't know it, but essentially you can roll it over to the next kid, though. It's kind of the important thing. You know, you have those dropouts.
Just roll it on to the next kid.
Now, there's something called a 529 plan. So this is a different one. This one has no income limits. This is what if you're above that income of 110,000, here you go. It's called a 529 plan. This you can contribute up to $17,000 a year.
That's a lot more.
Okay. Let's see. It's very similar. It's allowed for books, tuition, all the same expenses. It's allowed for. But this one you have to be more careful with. Okay. The ESA is very simple, right? Nobody's trying to steal your money. The 529 plans, they're trying to steal your money a little bit. You gotta be careful. They'll say you want they'll say like there's a flexible plan where they'll choose the fund for you and they'll invest it based on your kid's age. Sounds a lot like the other target date funds.
They'll find
a
high expense ratio fund.
Exactly. They find a high expense ratio and low performance and they go into that. Okay. There's also something called a fixed savings rate. So they'll say, we'll just give you 2% a year fixed. And then as your kid gets older, we'll up it to 5% fixed. But
that's not an investment. They're just giving you, like, they're not investing in anything. They're guaranteeing you a return.
They're putting it into a fund that guarantees the return of that. Okay. Stay away from that because the market's probably going to do better than a 2% and with a high expense ratio.
Yeah. Kind of.
Right. So those are called fixed or life phase funds.
Okay. It sounds like safe, but I mean, 2% is like, that's not
exactly.
It's not even inflation.
Exactly. So yes. So you have to be very careful with these because they're out to get you. They know a lot of people like to use them. So do your research, find the one that's closest to the actual market with the lowest expense ratio, and that's the one that you want to choose. But you're out on this one. This one you're also allowed to transfer to the next kid. Some don't, though. Some won't allow you to transfer to kid. Again, these are company by company, these plans.
Okay.
And then some you can actually transfer to yourself.
Oh, that sounds good.
No time limit on these. Okay.
Sounds pretty good.
Yeah, and so, but if it's a non-qualified expense, you do get taxed on it.
Okay.
But this is a $17,000 per year you can use it. So this is a very popular one, but you have to use the expenses for education.
And this is also a pre-tax thing.
Yep.
Right? Just like the ESA.
It is just like that.
Okay.
So it's very similar to the Roth IRA.
Oh, so wait. Is it pre-tax
Right?
money goes in, or taxed money goes in and comes out non-tax?
It's Roth IRA like.
Okay.
It's an
So
after
it's,
tax.
it's that one I just
Both ESA is like that
ESA
and
529 Roth
529.
IRA. You pay tax on what's going in,
Yep,
not what's coming out.
exactly.
All right.
Exactly. So 529 plan.
Good to know.
Good to know on that one.
Yeah.
All right, and then there's one last plan. This is, let's say you're past, you have so much money. This is even more niche. This is mostly for estate taxes. This next one, it's called a UTMA or UGMA. Okay, basically it's a brokerage in a kid's name. Okay, that becomes theirs when they turn 18 or 21. So, and they can use the money for literally anything, and it's their money.
Not even educational.
It's not even educational.
That's pretty good. Okay, so what are the terms? Is there an income limit, time limit? What are the constraints?
The biggest tax advantage is that is that essentially this is why it has to do with the states. So the biggest tax advantage is that you, the person putting your money into this, is probably going to be taxed at a really high rate. When you're the kid who gets this money, they're taxed at a much lower rate because they don't make any money at the age of 18 to 21. Right. So basically what these people do is they put this money, like a significant amount of money, into these. The kid becomes of age and they can take it out at a tax rate of like 10% versus theirs might be 44%.
Yeah.
So
is that the primary tax advantage? Is there any like pre-tax element here? None of that.
That is the primary tax advantage.
That's an interesting one.
Yes,
that's good for like family planning. And stuff.
If you have like a really large, if you paid off your house, you have some grandchildren, and you still have money left over, you can look into this. But that is a very small niche of people. But do know that money is now that kid's money, and I mean, imagine you're a kid and you get a hunk of cash.
It's good for the kid.
Good for the kid, but who knows what the hell they're going to spend that.
Yeah, you better raise them well.
Yeah, right, exactly. So that's the last tax shield. Pretty good. Any questions on taxes here?
No, I think that was a good breakdown of I think the core difference this really highlights is the difference between going with an IRA and a 401k, which it wasn't super clear to me, but now I see it's really the selection. 401k, I guess it sounds like it's more limited.
Yeah.
Maybe safer, more mutual funds. These IRAs have a lot wider variety of things you can invest in. That's why it's a lower limit, though, that you can put it in.
Exactly.
And then there's the Roth versus the traditional vehicles. Roth is...
Go with the Roth.
Generally, it makes sense because with retirement money, you're expecting it to go up in value.
Exactly.
And, you probably want to pay tax now and not on when it's worth 10 times more.
Yep. Exactly. You couldn't have said it better. So I did not know much about IRAs before this. Just putting it out there. So very interesting. Look at the contribution limits, obviously, right?
Yep.
IRAs are 7,000, right? So you put in up to 7,000 and you put elsewhere. 401k is 23,500, right? So, so doesn't make sense really to do much over that unless you want, right?
Yeah,
I mean, do whatever the hell you want.
Let's say you've done your 30,500 into your IRA and Roth or IRA and 401k combined, and you have money left that you want to save for retirement. Probably don't necessarily put it in those, right? Unless you really like what they're offering in their investment selection. Because there's just no more tax advantage.
Yeah, right. Really, all you're doing is locking up your money until you're 60, right? So you at that point, there's no tax advantage. You might as well put it into a brokerage where you can take it out at any point.
Yeah, definitely.
So just watch out for it, but also don't put in so much money that you can't live.
Yeah.
Make sure you can live. Make sure you pay off all your other debts, right? And then you have all these nice little vehicles. Yeah. And then really these vehicles, for most people, should be enough in terms of tax. I mean,
yeah,
right?
Put away enough, and the tax advantage really helps you save enough for when it's time to retire.
Exactly. So. I mean, for some of these, right? Imagine saving $4,000 a year, right? I mean,
add up.
That'll add up very quickly, right?
Get the tax savings.
That's almost a car.
Compounding.
You could almost buy a car with
Yeah,
that.
yeah, absolutely.
Yep. So that is all the time we have today. Well, we have more time, but we'll wrap it up here. If you want us to cover anything, like, please just let us know. We will cover it. We'll do our best. We'll do a great job, actually. We're coming out with these every other week, okay? We have shorts out that make us look really cool and have great animation, so go check those out.
On YouTube.
On the YouTube shorts. We are on the Spotify. You look up Hedgeye Podcast, and we are Hedgeye, NextGen in Hedgeye Podcast. This is also free content, so to my friend who didn't realize that this is not behind a paywall, this is totally free, so you can just listen to it, send it to your friends, let them know about us, all right? You can follow us on Twitter. I am Hedgeye AI.
HE Digital Assets.
HE Digital Assets. And yeah, that's it. Have a good time out there. Enjoy the 4th of July. Oh, and my birthday. So enjoy that too.
Happy birthday.
Thank you. Good luck.